Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at BitMine.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. The story here isn't just about mining anymore. Not really.
Right.
BitMine has successfully pivoted from, a pure self-mining operation into a dedicated crypto treasury and network company.
So they're diversifying.
Exactly. And that diversification, it reduces their reliance on those really volatile mining cycles.
Okay, let's unpack this a little. What really makes their operation stand out from other digital asset companies? I mean, is there a secret ingredient?
The secret is, well, it's operational efficiency. Their primary competitive moat is this proprietary immersion cooling technology.
Immersion cooling.
Yeah. And this isn't a small thing. It's reported to reduce data center operating costs by over 40%.
Wow, 40%.
40%.
Yeah.
And it provides a 15 to 25% lower operating costs per unit of hash power compared to their air-cooled rivals.
So that gives them superior profitability, especially when prices compress.
That's it. It's an incredible margin expansion.
And I also see they have a service model, mining as a service. So they're monetizing their infrastructure expertise.
Yes, and that must generate some pretty high margin recurring revenue.
Seems like it.
Exactly. And they also run a synthetic hash rate arbitrage business.
Okay, what's that?
They're buying discounted hash rate and then reselling it at a premium. It's non-mining revenue with, minimal capital expenditure. It positions them as a really sophisticated market maker.
Here's where it gets really interesting for me. Forget the operational side for a moment. Let's just talk about their balance sheet. They are now positioned as the world's largest corporate holder of Ethereum, right?
That's correct. And the scale it's difficult to replicate. As of the most recent disclosures, they hold 3.86 million ETH tokens.
And how much is that of the total supply?
That's over 3.2% of the entire Ethereum token supply. And their stated goal is to achieve the alchemy of 5%.
So they are essentially a liquid proxy for an Ethereum bet.
Pretty much, yeah.
With total crypto and cash holdings reported at, $13.2 billion and a market cap trading right around that number, you're basically buying access to one of the largest corporate crypto treasuries available.
And what's fascinating here is the institutional validation. The shareholder roster, it includes some very high-caliber crypto-native and growth investors.
Cool.
ARK's Cathie Wood, Founders Fund, Pantera, Kraken, DCG, Galaxy Digital, and Bill Miller III.
That's a serious list.
It is. It signals deep institutional conviction in their long-term accumulation strategy.
So if we connect this to the bigger picture, what does this mean for their earnings?
We're seeing a massive earnings inflection. For the last fiscal year, the company reported net income surging to $328 million.
Wow.
Which results in $13.39 in fully diluted EPS. That's a dramatic shift toward operational maturity and profitability.
That kind of earnings power seems to eliminate any lingering concerns about historical losses. I think the old accumulated deficit was, $13.9 million? It's immaterial now.
Completely.
So what about liquidity and balance sheet flexibility?
Their financial health appears robust.
Yeah.
They hold substantial cash, $1.0 billion in one report, and $456 million in unencumbered cash in another.
Okay.
And that's relative to very low debt, so they're maintaining a conservative capital structure. This flexibility is just crucial for buying into crypto dips.
I found a fascinating metric on the demand side. Customer advances,
Right.
which is prepaid revenue for their mining as a service platform.
Right.
It increased by 156% over just 9 months.
That's an incredible number. It signals exceptionally strong client confidence and, huge demand for their immersion-cooled hosting.
So this all raises an important question. What's going to drive the stock over the next, say, 3 to 6 months?
The answer is a dense stack of corporate and macro catalysts.
Let's start with the biggest operational driver, the BMNR network. Can you tell us about that?
So, AVAN stands for the Made in America Validator Network. It's slated for deployment in early calendar 2026.
And why is this so essential?
Because it should convert a portion of their multi-billion-dollar ETH treasury into a high-margin recurring staking revenue stream.
Ah, so turning the asset into a cash flow generator.
Precisely. Any detail on yield targets or institutional clients being onboarded will be a massive upside trigger.
And they also announced a new capital return policy, right? A dividend.
Yes, a planned annual dividend tied directly to the ETH treasury. That's a significant shift. It demonstrates management's confidence in cash flow and signals a focus on direct shareholder returns, even while they're still compounding asset value.
And looking at the corporate calendar, the annual shareholder meeting on January 15, 2026 seems like a must-watch event.
Absolutely. Management is expected to provide key updates on the Maven roadmap and the dividend framework there.
Plus, there are market signals of potential corporate restructuring.
Indeed. The prior reverse stock split and the large Form S3 shelf registration that was filed, it suggests management may be preparing for a major corporate event,
Such as?
such as uplisting to a major exchange or maybe some strategic M&A activity, which could trigger a significant valuation re-rating.
Okay, so no investment is without risk. And with this company, the massive concentration in digital assets, that seems like the main headwind. What's the bear case?
The primary risk is, without a doubt, crypto price volatility. The company's NAV and its future staking revenue are heavily concentrated in Ethereum.
Right.
So a deep and sustained crypto market drawdown would immediately impact the stock's valuation as it trades as a leveraged proxy for ETH.
So how is that risk mitigated, is it?
It is in two ways. First, the large cash reserve, around $1 billion, provides a significant buffer. And second, management and its institutional backers explicitly view that volatility as an opportunity to accumulate more ETH, which strengthens the long-term NAV per share.
I see. There was also news of a board resignation, and, they still need to successfully execute on Maven, right?
And that falls under execution risk. The board resignation introduced a little bit of a question mark on governance stability, but
Seems manageable.
it does. And the Maven's staking platform needs to be delivered successfully, securely, and compliantly to realize that high-margin revenue. Failure to execute would dampen the bull case. But the presence of sophisticated institutional oversight really helps to manage that governance risk.
So what does this all mean? BitMine offers highly scaled exposure to Ethereum. It's backed by top-tier institutions, and it's sitting on a rich catalyst stack driven by its high-tech operations and the launch of its new staking network.
It really is.
It's a multi-year growth thesis with significant tactical upside in the near term.
The combination of the largest ETH treasury globally, proprietary cost advantages, and those massive recent earnings makes this a really compelling story to follow into 2026. Make sure you keep up with all the details by subscribing and hitting that notification bell.
We'll be back tomorrow with another Smart Wealth analysis.